Good morning, everyone. As we look at the board today, Tuesday, October 21st, 2025, the U.S. markets are currently closed. We need to be very clear about that. The stock we are examining, Nuburu, trading under the ticker BURU, finished yesterday's session on October 20th at a closing price of 74 cents per share. It was a volatile day, even for a stock this low priced. It shed about 0.85%, but the intraday chart shows a story of a stock fighting to find a floor, opening much higher around 37 cents and touching a low of 31 cents before settling at that 34-cent mark. The volume was significant, but not in a healthy way. Now, the immediate expectation when you see a stock at 34 cents, especially one that claims to be in a high-tech field, is that you found a hidden gem. The assumption is that this is the ground floor of the next big thing, a speculative bet that could, with a little luck, turn a small amount of capital into a significant sum. This is the kind of stock that lights up the cheap movers screeners on platforms like the Robinhood app or SoFi Invest. The expectation is that you were buying Tesla stock when it was still just a concept, or Nvidia stock before anyone understood what a GPU could do. The reality, however, is that this 34-cent price tag is not a signal of opportunity. It is a mathematical reflection of extreme corporate distress, a fight for survival on the NYSE American exchange, and a shareholder base that has been subjected to one of the most painful dilutions we have seen in the tech sector this year. Let's establish the common ground, because the story Nuburu tells is a good one. The company develops and manufactures high-power blue laser systems. This is legitimately interesting technology. Why? Because traditional infrared lasers, which are the industry standard, have a very difficult time processing reflective materials like copper or gold. The light just bounces off. Blue laser light, however, has a much shorter wavelength and is absorbed far more efficiently by these materials. In a world rushing toward electrification, this is a big deal. Think about welding the copper components inside an electric vehicle battery pack, or 3D printing pure copper parts for advanced electronics, or even delicate work inside the high-end components that go into products from a company like Apple stock. The technology has clear, tangible applications. This is the expectation. This is what investors believe they are buying. The reality, however, is the business itself, and the business appears to be in a state of collapse. This stock is not trading at 34 cents because the market is sleeping on it. It is trading at 34 cents because it is failing publicly and repeatedly to meet the most basic standards of a listed company. Earlier this year, back in April 2025, Nuburu received a non-compliance notice from the NYSE American because its stockholders' equity had fallen below $2 million, while suffering significant losses. Just last week, on October 13th, it received another warning letter from the exchange, this time for a procedural failure. It announced a material change, a new dual CEO structure, without properly notifying the exchange first. These are not the actions of a healthy, growing company. These are the frantic moves of a management team just trying to keep the lights on. The stock has been trading under the $1 minimum bid price requirement for so long that its very listing is in jeopardy. This isn't an online investment for your retirement. It's a gamble on whether the company will even exist on this exchange next quarter. To fix this, shareholders approved a proposal in July 2025 to enact a reverse stock split. For anyone new to online investing, let's be crystal clear about this. A reverse split does not create any value. It is an accounting maneuver where, for example, every 50 shares you own might be converted into just one share. Your 10,000 shares, which you might have bought on Robinhood or through your Fidelity account, suddenly become just 200 shares. The price per share jumps up proportionately, say from 34 cents to $17, and voila, the company is back over the $1 minimum. But the total value of your holding is identical, and it's often seen by the market as a sign of desperation, a precursor to more selling pressure. Serious investors using Schwab Intelligent Portfolios or Fidelity Wealth Management Services see a reverse split as a massive red flag, not a buying opportunity. But that's not even the worst of it. The real story is buried in the filings, and it's a story of dilution so extreme it's hard to comprehend. In the same July 2025 meeting, shareholders approved an increase in the number of authorized shares of common stock from 250 million to 900 million. Why would they do this? To raise cash. The approved issuances for convertible notes and a standby equity purchase agreement, which are complex financial instruments that essentially allow the company to sell massive blocks of new stock onto the open market to fund its operations. The result? The data shows that in the last year alone, Nuburu's total shares outstanding have grown by a staggering 1,700%. Your tiny piece of the pie has been diluted into near non-existence. The company is burning through cash, with annual losses far exceeding its revenue. One data provider, PitchBook, lists its trailing 12-month revenue at a shockingly low $9,300 against a net income loss of over $44 million. The math simply doesn't work. And here we find what might be the final nail in the coffin. A filing from May 2025 references the impact of the previously announced foreclosure, which resulted in the loss of the company's patent portfolio. Read that again. A high-technology company whose entire value proposition is based on its unique blue laser technology has apparently lost its patent portfolio. How does a company like this even move forward? What is left to sell? What is the intellectual property protecting it from competitors? This is the kind of devastating development that explains not just the 34-cent price, but the flight of all serious capital. The institutional ownership of this stock is less than 1%. You won't find it in Fidelity ETFs or Fidelity mutual funds. The vast majority, over 94%, is held by the general public, often retail traders who are buying the story, not the financial statements. This is the tragic disconnect between expectation and reality. Comment below if you think Nuburu can find a way to reacquire its patents, or if you believe the loss of its core intellectual property is the end of the story. So what does the future hold? The expectation, the hope, is that one of those EV manufacturers or a defense contractor will swoop in with a massive company-saving contract or a buyout. The reality is that the path forward is almost impossibly bleak. The reverse stock split will likely happen, which will consolidate the shares and artificially boost the price. But this event itself is often shorted by sophisticated traders on platforms like Interactive Brokers. They know that once the price is higher, the company, which is still burning cash, will likely use its 900 million authorized shares to issue even more stock, driving the new higher price right back down. The primary risks are a complete delisting to the over-the-counter markets, where liquidity dries up, or eventual insolvency. This isn't investment help. This isn't even self-investing in the traditional sense. This is high-stakes speculation. When you look at a stock like Nuburu, you are not buying a piece of a business in the same way you would buy a share of Apple stock or even a speculative growth play like Tesla stock. You are not participating in a Schwab Intelligent Portfolio strategy. You are holding a lottery ticket, and the numbers are not looking good. The company's technology, the blue laser, was and is a genuinely good idea. But a good idea and a viable investable business are two completely different things. To summarize, the market has created an expectation that BURU is a cheap tech stock with interesting applications in the EV and electronics space. This is the story that gets passed around on forums and social media, attracting traders on platforms like Robinhood Stock Trading and SoFi Investing. The reality, however, is that this is a company on financial life support. It is facing delisting from the NYSE, it has diluted its shareholders by nearly 1,800% in a single year, and most critically, it appears to have lost its core patent portfolio in a foreclosure. The 34-cent closing price is not an entry point, it is a warning. The expectation is a high-tech future, the reality is a business that has been hollowed out. Disclaimer. This video is for educational and informational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions. The stock market involves risks. Invest wisely. Like, comment, share, subscribe. If you found this video helpful, don't forget to like, share, and comment your thoughts below. Your support keeps us motivated to bring you more stock insights every day.